The economies of the United States and the other G4 nations are still struggling and are in danger of falling into another global recession. But even as growth slows in the West, the demand for natural resources remains strong. So investors are turning to three developed markets that are poised to take advantage of the commodities boom: Canada, Australia, and Brazil. These countries offer the best of both worlds, safety and the potential for huge returns. This week, we'll tell you how to cash in on that trend. Why are those three economies in such better shape than their neighbors, and what's in store for their currencies? Rowland and Bryan Rich will answer those questions. We'll find out how to play the Canadian, Australian, and Brazilian stock markets using exchange-traded funds, plus a discussion with Brodrick and Rudy Martin. They'll recommend specific stocks and sectors that could take off. All that and a final comment from Martin Weiss coming up right now on Money and Markets.
From our studios in Jupiter, Florida, Weiss Money Network presents Money and Markets. And now, Jamie Holmes.
Hello, everyone. Last week on Money and Markets, we told you about several up-and-coming international markets, including Colombia, Indonesia, Vietnam, Turkey, and South Africa. Now, those economies offer intriguing upside potential for intrepid investors, but this week we're focusing on more established markets that could promise similar returns. And here to help us learn our ABCs, that is Australia, Brazil, and Canada, is Rowland. Hello, Ron.
Hi.
Ron, what are you seeing in all three of these countries that tells you these are solid investment options?
Well, Jamie, at first glance, those three countries seem to have very little in common, but upon closer inspection, they're really quite similar in several ways. They're all very large in terms of land mass. They all have pro-trade, pro-business democratic governments, and most importantly, they're all major exporters of natural resources.
I know commodities prices have been rising in general for the last couple of months, and in the case of gold, for much longer than that. But why are you so focused on that particular asset class?
Well, I'm thinking long term. I mean, the global demand for commodities is projected to increase for decades to come. Australia, Brazil, and Canada are well positioned to take advantage of that trend. As opposed to many other countries with abundant natural resources, theirs are much more accessible. In addition, their economies are already set up to encourage exportation. And they're all strategically located. Canada borders the U.S. and has ports on both the Atlantic and Pacific Oceans. Brazil also has ports on the Atlantic, and it borders all but two South American countries. And Australia is very close to India, China, and other Asian countries.
China, of course, its economy is still humming along despite the slowdown that we've seen here in the U.S. and in Europe, and that has obviously been a huge factor in Australia's growth, right?
Right. Over the past 20 years, China has grown from being Australia's 10th largest trading partner to #1. But Brazil, too, has benefited from its relationship with China. Last year, China became Brazil's top two-way trade partner. The two countries also signed a 5-year action plan aimed at boosting trade and energy cooperation even further.
Let's dig a little bit deeper into these individual economies. Why, aside from its relationship with China, is the Australian economy in such good shape right now?
Well, first of all, its natural resources track high levels of foreign investment, and not just from China. Australia has big reserves of coal, iron ore, copper, gold, natural gas, uranium, and renewable energy sources. But it's coal that really drives the economy because coal still provides much of the world's electricity. And Australia is the world's largest net exporter with nearly 30% of all global coal exports.
Well, was it just energy demand that kept Australia out of a recession last year?
Well, no. Its economic policies had a lot to do with it as well. When the world economy started to slow a few years ago, Australia's government introduced a $50 billion stimulus package. At the same time, the Reserve Bank of Australia cut interest rates to historic lows. Now, those actions allowed the country's financial system to stay resilient throughout the financial crisis. And that allowed Australia to become one of the first advanced economies to start actually rising interest rates 3 times since October. That gives the central bank plenty of room to lower interest rates again to combat another global economic downturn.
Sticking with our ABC theme here, Brazil is another country with a rising interest rate environment, right?
Right. In fact, Brazil's interest rates are much higher than either Australia or Canada. And Brazil has steadily improved its economic stability in all sorts of areas over the past few years. Building up foreign reserves, reducing its debt profile, sticking to an inflation target, and committing to fiscal responsibility. All those factors helped Brazil recover relatively quickly from the global economic downturn of 2008 and 2009. And now, Brazil's future looks extremely bright. It's hosting the World Cup in 2014 and the Summer Olympics in 2016. If it maintains its current GDP growth of about 5%, Brazil could become the world's 5th largest economy by 2020.
Okay, let's turn our attention now to our northern neighbor, Canada. Lots of similarities there to the U.S., but its economy is in much better shape. Why is that?
Well, just look at the trade flows. I mean, Canada has a huge trade surplus with the U.S., and Canada is our biggest supplier of crude oil, natural gas, uranium, and electricity. That energy demand from the U.S. and the rest of the world will be key drivers of economic future. It's already the world's 5th largest energy producer with 180 billion barrels of combined oil reserves, both conventional and oil sands. That's second only to Saudi Arabia.
All right, Ron Rowland, thank you so much. We're going to bring you back in just a few minutes to tell us how investors can further take advantage of the opportunities in these countries using exchange-traded funds. Thanks, Ron.
Thanks.
Well, we were just talking about the economic environment in these commodity exporting countries. Let's dig a little bit deeper into that. What do rising growth and interest rates mean for the currencies of Australia, Brazil, and Canada, and for investors looking for ways to play those markets? Joining us with some answers is currency expert Bryan Rich. Hello, Bryan.
Hi, Jamie.
Bryan, what are you seeing in these three countries that bodes so well for their currencies?
Well, Jamie, as you alluded to, the main drivers of currency appreciation are superior relative growth and rising interest rates. Canada, Australia, and Brazil all meet those criteria. That's why they fared better than most economies during the last global recession, and it's why capital will likely continue to flow into their currencies if they can continue to perform despite the souring major economies of the world.
Right, and it's a much different story there in those other developed economies, right?
Especially the G4 countries, the United States, the Eurozone, the United Kingdom, and Japan. None of those economies will grow above 3.4% this year, and they're all expected to register even slower expansion next year. The U.S. will probably perform the best among the G4 countries, but its GDP growth isn't likely to top 3% next year. The fact is, even these projections will likely turn out to be overly optimistic. Now, growth in Canada, Brazil, and Australia will likely decline next year as well. And Canada in particular may be hurt by the slowing demand from the U.S., but the relative growth in those economies will still be much better than in the Eurozone, the U.K., or Japan.
Okay, and what about the interest rates in those countries?
Well, we see an even bigger difference there when we look at those numbers. In the U.S. And the other G4 countries, central banks have cut rates to the bone to combat slowing economies. They may rise next year, but it's far from certain at this point. In fact, the Fed recently indicated it would try to influence rates even lower through more easy money policies. What's important here is that we're seeing the opposite trend in Australia, Brazil, and Canada. Brazil is the most dramatic example, with interest rates there well above 10%. But the key is that all these countries are in interest rate tightening cycles. Interest rates, or investors rather, are starved for yield. So these countries tend to attract global capital, which tends to put upward pressure on their currencies.
And I'm assuming here one of the reasons that they're in such positions of strength is their growing demand for their commodities, right?
That's true. Australia and Brazil are in especially good positions because so much of their natural resources go to China, where the demand for commodities has been exploding. Canada's position is a bit more tenuous because its economy is so tied to ours here in the U.S. If the U.S. continues to struggle, as it's shown in recent data, the Canadian dollar may underperform those other two currencies. But it's not just commodities. Commodities aren't the only reason these countries are attractive.
And why else is there?
Well, their fiscal responsibility compared to the rest of the developed world. Debt and deficits are extremely bloated in the G4 countries, and that's been punished by investors. But the deficits in Brazil and Canada and Australia are much lower, especially when you look at it as a percentage of GDP. They're much more sustainable, and that tends to make them more attractive.
Okay, Bryan Rich, thank you for joining us.
Thank you.
Okay, now that we know why these countries and their currencies are likely to outperform, it's time to focus on how to profit from that trend. Coming up next, Ron Rowland will be back to give us his ETF picks in Canada, Australia, and Brazil. And later, we'll even get more specific stock and sector picks in all three countries from Brodrick and Rudy Martin. And as always, we want to hear from you. If you have any questions for any of this week's guests or suggestions for topics that you'd like us to cover, just email us at weissmoneynetwork@weissinc.com. Money and Markets will be right back.
America is in trouble. Federal and local governments owe over $123 trillion. New debt is escalating at the rate of $183 million per hour. That's $1.6 trillion per year. Bond prices are plunging, and that could drive interest rates sky high, triggering an even deeper recession. If you are worried, and you should be, download Mike Larson's blockbuster new report with urgent investment recommendations to help you protect your wealth and profit. Don't delay. Do it now.
This week on Money and Markets, we've been learning our ABCs, Australia, Brazil, and Canada. Those countries are poised to take advantage of exploding demand for natural resources. But what is the best way for investors to profit from that trend? Joining us again with some picks and pans is ETF expert Rowland. Ron, how would you recommend investors get into these markets?
Well, Jamie, all these countries have multiple exchange-traded funds, and I think any one of them will give investors solid returns. So what I'd like to do today is look as closely as possible at the individual funds for each country and determine which are going to be the biggest winners in the commodity export boom.
All right, fair enough. Let's start with the country U.S. investors are probably most familiar with. That, of course, is Canada. What are our investment options there?
Canada has the fourth largest single country ETF, the iShares MSCI Canada Fund, ticker symbol EWC. It's been on a nice uptrend since hitting a low last March, and it's by far the most popular Canadian ETF, focusing on large cap stocks. But investors now have a second option, and that's the IQ Canada Small Cap ETF, ticker symbol CNDA. It's only been around since March and hasn't moved much since then, but it's an option investors should know about.
Okay, which of those ETFs then provides better exposure to the commodities sectors of the Canadian economy?
Well, I look at their asset allocations, and they both invest heavily in energy and material stocks. If we just focus on energy companies, the large cap fund has a slight advantage. But take a look at the materials line. The small cap ETF has more than half of its money allocated to those stocks. So that tells me that CNDA will give me a better return on my investment when those sectors of the Canadian stock market rally.
Okay, what about Australia? Same story there?
Yeah, investors have very similar ETF choices in Australia, and in fact, their performances track closely with their Canadian counterparts. Like EWC, the large cap iShares MSCI Australia Fund has been around since 1996, but it's no longer the only game in town either. At the same time that IQ introduces Canadian small cap ETF, it introduced a version for Australia with the excellent ticker symbol of KROO.
Okay, what's the asset allocation of those two funds?
Well, in the Australian energy sector, both of them have relatively minor allocations of less than 10%. However, in the materials sector, KROO's allocation is approaching 40%, while EWA's is just 26%. So once again, I would tell investors go with the small cap fund to benefit from commodity exports.
All right, let's move on to Brazil now. Do investors looking to buy into that market have the same ETF choices as in the other two countries?
Well, no, because Brazil's ETF market has even more choices than either Australia or Canada. So in addition to a large cap and small cap options, there's also a mid cap and infrastructure funds to consider. If you look at the asset allocations of those four funds, you'll see that the large cap ETF, the iShares MSCI Brazil Index, has 48% dedicated to energy and material stocks. That's nearly 4 times higher than any of the other 3 funds. Again, I'm not saying you shouldn't invest in those funds. In fact, if you like Brazilian telecommunications and utility sectors, I think the infrastructure fund, ticker symbol BRXX, could provide very solid returns. And you'll soon have even more options to choose from because Global X Funds has begun rolling out a series of Brazil sector ETFs, including one focusing on just materials. So investors looking to profit from materials from Brazil's commodity exports may want to wait for that one to hit the market.
All right, Ron Rowland, thanks so much for your time. Coming up next, we'll dig even deeper